Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Joe Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, we have Brian Joyce. He's the Managing Director on the Nasdaq Market Intelligence Desk. We're going to take a look at why small cap underperformance may not necessarily be a bad thing and also get a lesson in how to use ratios in your technical analysis. Brian, it's great to have you with me as always. And this was a key theme in June, kind of separating out the defensives from the small cap stocks.
Yeah, so in June, we were rebounding from the decline in May, which was the first month that we were down this year, but there was still a lot of skepticism. The defensives were leading and small caps were underperforming during the month of June, despite the overall strong rebound. So people were pointing to that as maybe a canary in the coal mine or a warning signal as to maybe the market is close to topping out and people should underweight risk. And it just didn't really seem to make a lot of sense to me. Defenses were doing well because the Fed was getting closer to cutting rates, and they were affirming that in their meetings. We had a meeting in late June, June 19th, where they essentially affirmed that they are getting close to cutting rates. And then as far as the small caps underperforming, it was just very short-term underperformance. They underperformed this year. They're down about they're up 16% versus the S&P right now, which is up 20%. So yeah, they are underperforming this year. And last year they underperformed as well by about 6 percentage points. This year it's about 4 percentage points. But if you go back to the lows of 2016, which was a significant low, I just ran the numbers this afternoon. The S&P is up 65.3%. The Russell 2000 is up 65.2%. So almost identical returns.
All right, before we get into the charts here, explain to us what a ratio is and how technicians use them.
So a ratio is when you plot one security over the other, a simple fraction. And when the numerator is outperforming the denominator, the line on your chart will trend higher. And vice versa. When the numerator is underperforming, that line will trend lower. Technicians will use it because it provides a good illustration or a good visual as to what is outperforming and what is underperforming, and you could look at it over various time frames. Most of the technicians at the big Wall Street banks, what they like to do is look at the ratio charts of the main 11 sectors of the stock market, the GICS, versus the S&P 500. They like to plot that on a weekly time period and use the 40-week moving average, which is synonymous with the 200-day. And whatever ratio is trading or is priced above that 200-week average, it's essentially seen as being one of the sectors that's outperforming, and that's where you want to have a greater allocation to, so you could generate some alpha, i.e. outperform the market.
All right, let's take a look at our first chart here. This is the Russell 2000 versus the S&P 500. This is a daily chart.
So this is a daily chart, correct. So it was spanning the last 3 or 4 years or so, but what I wanted to highlight here is going back to, so this is small caps, the ratio of the small cap index over the large cap index. And so we see that it peaked back in the late summer of 2018, which was almost exactly where it peaked in late 2016, right after the election. And then it began to roll over. So when we didn't get that breakout to new highs, it was, in this particular case, a signal that the markets were kind of rolling over. That eventually happened a couple of months later. It's now making new lows. It's trading below the lows reached in early 2016, which was a significant low in the stock market overall. And so people have been pointing to that, saying this is a reason to be cautioned and reduce your risk. But I think it's a very short-term analysis. If we look at the longer-term trend of the same ratio, which is the monthly period, and we go all the way back to 1980. We know from the 1980s, early 1980, 81, up until the year 2000 was a phenomenal secular bull market run. If we could flip to that monthly chart.
That's the next chart. Yep.
We
can
see
that longer term outlook. Yep.
That for the majority of it, from 1983 to 1999, small caps underperformed most of those years. It was a period in the early to mid 90s where the small caps had a relief rally of relative performance, but we could see the longest 16-year trend was to the downside. So the point here is, even if small caps begin to dramatically underperform, which they are, as you can see on the right now, this month breaking below a 10-year support line, even if that breaks down, it doesn't necessarily mean on an absolute basis that small caps and large caps are not going to do well, because as we saw in the 80s and 90s, small caps largely underperformed, and that was during a phenomenal bull run for both types of asset class sizes.
Now, if we go to our last chart here, this is the Dow Jones Industrial Average. What are you looking at here?
So this is a long-term monthly period chart. We have the 2009 lows here. It ran up until the early 2015, and then it peaked for about, it consolidated for about 20 months sideways into the end of October of 16, and then when we had the election, the Trump bump, so it's termed. In the next 15 months, the Dow Jones rallied 47% in just 15 months' time. We're going through a similar period right now where we've been consolidating for about 15 months, a little bit of a shorter consolidation, but somewhat similar. The trend line from the December low matched exactly where the line comes in from when you connect the lows from 15-16 and the lows from 2009. So it held a significant support line, and this month is just beginning to break out to new highs. Today we hit the 27,000 milestone. Not to say that at this time again it's going to rally 45% in 13, 15 months time, but it's certainly a bullish breakout. I like the momentum indicator, the MACD, which is close to crossing over its signal line, which we did see it again.
It looks almost similar, the pattern, with the exception of the duration, that 5 month duration.
Yeah, so very similar, very similar.
Yeah.
So we'll see. Things could always change, but you clearly have a level where you can measure your risk. The breakout level, which is around 26.6, that's what you could use
Right.
to gauge what your position size should be.
Which is so interesting because every time we do this segment, you're always talking about measuring risk at the
Right.
end, and that's what these charts help you.
Well, because a lot of times the people who are really focused on the technicals tend to have a shorter term time frame, and if you're going to invest that way, the market is going to get whipsawed around over the short term, so you don't want to get shaken out by that. If you don't have risk levels, you're going to end up selling low and buying high and chasing, and next thing you know, 12 months have gone by.
That's no bueno, and then you have no more money in your account. All right, Brian, as always, thanks for joining us.
Thank you.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global